Welcome to the daily update, where I will go over what happened on Wednesday, January 19th, and then we'll see how things look for Thursday, January 20th. And I'm trying to arrange the screen a little bit different this time because I'm getting too many things flying up that I would rather not have. But to go over what happened on Wednesday, we did have a gap higher at the open, but what is very common, selling came into the market, and that selling strength continued and got even stronger, and it took prices even lower. Then throughout the day, selling did break through last week's low, which is right at around 4,600 for the S&P 500. Now that we're below that, we tried to come back up to that level a couple of times, and it's acting as resistance. So if we're going to see some kind of a recovery through this, at least on a short-term basis, we're going to need to see prices come back above 4,600. There were failed rebound attempts throughout the day, and the selling continued. And then as we got closer to the close, selling gained momentum, and we ended up finishing down about 1%. It was 0.97%. The charts continue to show weakness, and they also continue to show technical damage. On a positive note, as I just mentioned a little bit ago, we are possibly at short-term support right now. Now, we could blow right through that, either in the overnight session as the futures trade or by opening lower on Thursday. But right now, and I'll show this to you on the daily chart, we are at what could be considered some very short-term support. Volume was above average. And as we've been stating all along, the current fixation is on earnings, inflation, and interest rates. Some of the things that we can say about what happened on Wednesday is there was continued broad-based selling in all of the major stock indexes, from the large caps, mid caps, small caps, NASDAQ, Dow, pretty much across the board. And those who for the last couple of years have been buying the dip, well, right now that's not really working. So people that are implementing that strategy, they get in thinking that we're going to rebound because that's what's been happening in the past. Well, it's not really happening right now. So they're starting to see losses. And once things shift on them, positions that they just got into, once their stop losses are hit or they start to see a significant loss, they get out of those positions, and that can help increase the amount of selling that takes place. The market continues to be overvalued and will be for quite a while, and has been for quite a while. Now, again, with the trend, we are not trending. We're still below 20 on the ADX, but we have turned up and come across the 5-period exponential moving average. So if you're a little more aggressive with that indicator, it looks like a trend may be developing. And on a short and intermediate term basis, the bias remains negative. So let's look at this session that happened on Wednesday. First, we look at sentiment. We're still just about neutral when it comes to fear and greed. And then looking at the chart, we're right in between right now. So we're not showing any kind of an excessive reading. When we look at the VIX really did climb on Wednesday. So that's just showing an increased amount of fear because people are starting to hedge their S&P 500 positions. Looking at the sectors, we're still seeing overall weakness throughout the sectors. Yesterday, technology was really weak. Today, discretionary, things that you don't have to have, that showed real weakness today. The financials, which had been holding up okay, they saw some weakness, but we're seeing continued weakness in technology. There were two different sectors, utilities and consumer staples, things that people have to have. So we're still seeing a shift over from growth-oriented stocks into value-oriented stocks. Then We just look at this in a graphical form where energy still continues to perform about the best of all the sectors right now. As far as inflation, we're looking at the BDI and it continues to fall. And as I've stated in other videos, there's two scenarios that we're looking at, either that this indicator is useless or it's telling us that inflation is not as bad as is being perceived right now. Fed Watch, I'm including a couple additional charts right here. For the January 26 meeting, there's almost a 92% chance that interest rates will stay where they are right now, between 0 and 0.25%. We're starting to also see a real shift up for the March meeting. We're into almost 90%. We're at 89.3% probability that in March, interest rates will be raised from 0.25% to 0.5% in that range. And there's even some people that are saying that we might raise them higher than that. Now, what I'm going to include now is we look at the May meeting, because they're starting to talk about, well, at first there might be one interest rate hike in 2022. Now, as we're seeing more economic growth as far as the reports and some real strength and inflation being a real concern, now we're starting to look further out, and the market's looking at 2, 3, possibly even 4 interest rate hikes. Now that could all change as these economic reports come out, as things happen. So we just have to look at things as they are right now. But if we look at the May meeting, it's right at about 50-50. Are they going to raise interest rates or not? Then we're also looking out into June, where we're seeing a pretty high potential right now of an interest rate hike at that time. But these will constantly change every day and adjust as time goes by and as we get closer to these meetings. So let's look at the intraday chart. Over here, way on the right-hand side, we see Tuesday's close. We had a gap up and we were above this black line, which was last week's low, which now you can't see on the chart anymore. But it looked like, okay, we're getting off to a pretty good start. But then we ended up going sideways. We didn't really take off to the upside, so prices fell back down. And now we did drop below where we were on Tuesday and below this black line. We tried to find some support, and now we came back up to last week's low, and that is now acting as resistance. We fell back down off of that. They tried a little bit of a recovery. When that didn't work, we got almost back up to the unchanged level, and then that acts as either a support or resistance level intraday as well. But when that really didn't show any renewed buying interest, we saw, especially during the last hour, some real renewed selling. I mean, closed right down to about S2 on Wednesday. So it was pretty negative action. There was more convicted selling going on. And as I say here, previous short-term support is now resistance. So that's just something we want to keep an eye on. It's at a round number, not necessarily a technical analysis important number, but more of a psychological number, because the markets participants, they like round numbers, and the financial media just loves that stuff. So I'm also adding a little bit to this chart. This is just a daily chart. The green bars show an up day, the red bars show a down day. Here's the line that I had yesterday showing that we're still making a series of higher lows as we go higher. Well, we just broke through that. And then I also added the pivot points, the monthly pivot points. This was acting as support, this S1. Well, we closed down below that right now. So this is starting to show some continued weakness, at least on a technical analysis basis. Volume was a little bit lower than on Tuesday, but still above average. We're still seeing that tug of war between growth and value. Growth stocks are really starting to decline as we're seeing value stocks really start to see some improvement. Looking at our trend, this is what I'm talking about, where we're below 20 with the ADX, which if you use this as a static number, that means boom, you're in sideways strategies or credit strategies placed either above or below current prices. If you're more aggressive with the ADX, that's starting to turn up. So you may consider this to be a trend. And because the red line is above the green line, that means this trend is down. Looking at breadth, advanced decline, we did see an increase in declines based on price and volume, but not as much as what we saw on Tuesday. Tuesday was a little bit more negative than Wednesday, but we still had a down day nonetheless. It was especially discouraging to the bulls in the market because we were up pretty strong only to fall back and then close down about 1%. And then looking down below, we're seeing prices roll over based on price and on volume. This chart had been holding up a little bit better. Well, we're starting to really see that turn down. And if we drop below this moving average, that will even show things as being more negative. Looking at the advanced decline ratio, it was a down day. We come off of this extreme positive reading. We've dropped down below zero, and the blue and red line continue to decline. Then looking at the new highs, new lows, we're seeing new highs really trailing off. Not a real pickup in new lows, but it's a little more negative because we're seeing the new highs not really showing any strength right now. So on this top line, we're seeing the red line below the blue line, that's negative. And with the 10-day moving average, we're seeing this start to trend lower overall, which is also negative. Short term, looking at the 20-period moving average, we're still seeing the blue, which is the exponential moving average. So it calculates quicker than the 20-period simple moving average, which is a little bit slower. And price is below both of these moving averages. Then looking at other moving averages, based on the 20, we're seeing a decline, and the 50 a decline, and we're starting to see a little continued weakness on the 200-day moving averages. The MACD is negative and still heading lower. The short-term Swinland trading oscillator based on price is continuing to be negative, and based on volume is negative. McClellan oscillator, now we're starting to get down below this blue line where we're seeing a bit of an extreme reading. We're going down a little bit too far, too fast, according to this indicator, which may lend itself into some kind of a bounce at some point. The stochastic RSI, it's pegged down into oversold territory and can continue to ride in this area for a while before it decides to bounce out. Then I'm seeing some interesting things on the rate of change charts. This is a 5-period rate of change where we're starting to go down a little bit extreme. So over a 5-day period of time, we're seeing prices decline pretty fast, which might lend itself to some kind of a short-term bounce. Whether if we do get a bounce at some point, either on Thursday or Friday, will that bounce just be a reactive bounce to an overall negative trend that's developing, or will we see that bounce up and switch everything back over to a positive environment? We don't know that at this point. Then I'm also showing the 10-period rate of change. That's also showing us a bit of an extreme reading. Doesn't mean it can't go lower, but if you look over the last year, this is lower than we've been for quite a while. And other times when we got down to this level, that ended up being a short-term recovery. And then because the environment was a lot more positive, it turned into an actual uptrend. So we have to wait to see if that will happen this time as well. And then I also have the 50-period rate of change. It's We're not showing an extreme reading. The only reason I brought this chart up is because we're dropping below this zero line, and this is lower than we've been in about a year. So we're seeing a little bit more strength when it comes to the selling than what we have been seeing. Intermediate term, looking at the 50 period, we're still seeing the red line above the blue line, which is slightly negative, and both moving averages are starting to show signs of rolling over. Then looking at the PMO, the price momentum oscillator, the oscillator itself is negative, and then based on price is negative. And this has been holding up based on volume, but now we're starting to see some weakness here. Then the other PMO study, those that the stocks in the S&P 500 that have a rising PMO, that's really down in negative territory, but we're dropping below this red line, which is kind of an extreme negative reading. The PMOs that are giving buy signals is also decreasing, and those PMOs that are even positive is also decreasing. So we're seeing a real a technical picture that is starting to show some across the board weakness right now. Doesn't mean we won't recover, but we're just seeing some real weakness. The bullish percent index, this continues to fall as we see a lot more point and figure sell signals being generated. The rainbow, even though the moving averages are still holding up, the blue line and all these moving averages, they're not bunching together, but now we're seeing price really start to penetrate some of these moving averages. And if we continue sideways to down from here, that could turn our little rainbow and have it start flipping around. The stochastic studies, short term, yeah, we're oversold. Intermediate term, we're getting into oversold territory. The full stochastics, we still have a ways to go. Then the vortex is still showing the red line above the green line, which is negative. The summation index, we have rolled over and are heading down based on price and based on volume. All of our momentum studies, they are pretty much across the board going down. The CCI, it's still down into an extreme negative 100 reading right now. Again, it could stay here for a while, but we're starting to see more and more of our oscillators and indicators show extreme negative readings. And when we start to see a lot more of those, that means that some kind of a bounce may be happening in the near future. The Williams percent R, it's also pegged down at the bottom. And then the Ulcer Index, which again, I showed this in yesterday's video, where it looks like we're having an extreme reading. And over the last year, yeah, it's getting high. Ulcer just means you're all freaked out and concerned about things. But when you look at it in a little bit longer context, yeah, it's higher than it's been in the last year or so, but this can still go quite a bit higher, as we saw in the COVID plunge. So we want to just maintain our context with this indicator. Then this is another one that I'm including today. This is the Copic Curve. This doesn't do a very good job of showing us tops, but this indicator was developed to help show us bottoms. And we're starting to see this go down to areas that has been a bottom in the past. So we'll just have to see how this plays out. And then I have a longer term view of this same chart. Yeah, we could still go lower, but in the last year or so, this is kind of the extreme negative reading. If we're going to maintain this overall positive environment, we would want to see things start to turn from here based on this indicator. But this indicator could also continue to go lower. And then we have another chart. This is a new one that I'm doing some experimenting with, and I'm going to try to zoom it in here. What I'm trying to measure is how far prices are away from the moving averages. And because the moving averages tend to act like a magnet or a rubber band, where if price gets too far away, they'll snap back. Well, I have some different MACD settings that I'm showing right here, and they are showing some extreme downside readings right now. I also have some other MACD settings that are also showing extreme readings. This is just something I'm playing with. And then another oscillator at the bottom that's not really telling us too much, but since these are giving us some extreme negative readings, I wanted to show this to you. Just, it's also suggesting that we've fallen a little too far, too fast. Some of the trading systems that we look at, the Elder system, we broke through the moving average, and these are red bars, and now the moving average is starting to roll over. The MACD based on this system is also showing a pretty negative reading right now. The Elder system, the dots are above, which means this system is measuring that as the downtrend. Some of the different charts that we look at, we have the Heiken Ashi chart. It continues to show solid bars, which is negative. The Kegi chart, I just ended up putting the name on here because I kept forgetting the name of this one. You see this little red coming down here. That's also showing some negative signs that weren't there yesterday, but now we're seeing them today. The Kegi chart added another red box right here, which is also negative. And the 3-line break is also starting or continuing to show weakness. So we're seeing some real weakness right now, but we could be at some kind of an extreme negative reading at this point. The equivolume, we also are showing a negative reading. The ease of movement based on one period really isn't telling us much, but based on 14, yeah, we're seeing more of an extreme reading than what we've seen over the past year. So if things are going to rebound, they might rebound pretty soon if we stay in the same context of where the market has been for the last year to year and a half to 2 years after the COVID plunge. This is a new chart too. I don't know if a lot of you use these, but I rely heavily on point and figure charts. X's just mean prices advance. O's mean that prices are going down. This is not based on time. We're just looking at price. So if it takes you 10 years to climb a defined amount to register a new reading on this chart, that doesn't matter to the point and figure. It could take you 10 minutes. So we don't really play time into this. I just used the default settings on this chart, but since we drew a new 0 on here, that means the decline is getting picked up by the point and figure chart. But overall, with this blue line going up, we put those underneath a positive trend. Some of the long-term or the one long-term chart that we look at, we're seeing weakness across the board as far as the S&P 500 and the S&P 500 equal weight index. Some broad market things to look at, the S&P, which we've been analyzing. Here are the mid caps. They're showing continued weakness, and small caps. Everything had a pretty bad day again on Wednesday. Here's a longer term view of those same charts. Then, if you have been in bonds over the last couple of years, you're really disappointed. Actually, this goes back to 2012. And other than some short-term little blips right here, stocks were definitely the place to be over bonds with yields so low. Even though we saw bond prices going up and up and up, if you bought them based just on capital gains, you probably did okay. But overall, stocks really have outperformed bonds. Here are the FANG stocks. They're showing some continued weakness. We have dropped again below the 200-day moving average, and the 50 is starting to roll over. Here's the ARK ETF that I'm starting to show. It was also down about 1.5%. on Wednesday. Here are the industrials, the Dow. This is kind of a critical thing. At other times, when you have some of the major indexes, the Dow, the NASDAQ 100, and the S&P 500, when they get down to their 200-day moving average, that's quite often where one of these indexes will make a stand and provide support. And if it starts to bounce up off of the 200-day moving average, the other indexes may follow. So we want to keep an eye on this. Even though we look at the S&P 500, we want to keep an eye on the Dow because of what could potentially be developing. And this is just a longer term chart of the Dow. Then looking at Dow theory, we're seeing weakness in Dow prices. The trannies are rolling over, and utilities, even though they're doing okay, they're still also starting to show some signs of weakness. And I include those in my own Dow theory studies. Looking at mid caps, we closed a little bit below the 200-day moving average. Well, we dropped below that, and we're also below S1 on the pivot points for the monthly chart. Excuse me, the monthly chart of the mid caps. The NASDAQ, it had been holding fairly well above the 200-day moving average until Tuesday. We dropped below that. Then on Wednesday, we not only dropped below that, but we've dropped below S2. So we're seeing some real weakness right now. Here's the NASDAQ 100. This is another thing to keep an eye on. The leader stocks, the Dow stocks and the NASDAQ 100 stocks, they're coming down right here to S2, and both indexes are getting close to their 200-day moving average. So we want to watch those indexes on Thursday to see, are we going to bounce up off of those? We've done those things before. Is that going to happen this time? Then the New York Stock Exchange Composite, which had been holding up fairly well, it dropped below the 50-period moving average on Tuesday. We closed below it again on Wednesday, and we're just a little bit below the pivot point on the NYSE Composite. So that's also showing some weakness. Okay, and then we have the Schwab Total Stock Market Index. This is just showing, I just like to bring this up because it's kind of showing everything together. I don't really use this to do any studies on this right now. I just look at the overall chart, and this is longer term. Then the Wilshire, another thing that happened here is on this very broad-based index, we did close below the 200-day moving average on Wednesday. That's decidedly negative. We want to see if the Dow and the S&P 500 and the NASDAQ 100, if they come through and start to show some strength. This is just a longer term look at the Wilshire. Here's the world stocks, which again, the US makes up most of this, but we've dropped below our 50-period moving average, and we're coming down to test the 200-period moving average. But you can see longer term, the blue is above the red, so the long-term trend still remains positive. Looking at some of the different world indexes, China and the emerging markets are looking more positive. Europe is pretty much flat. Japan is showing some promise. So Asia is actually performing a little bit better right now. And if we go down to the bottom, we see the S&P has pretty much rolled over. Some other markets that we look at, copper has still been trending sideways, but it was up over 2% on Wednesday. The dollar, after having a really strong day on Tuesday, it fell back just a little bit, but it's still above the 95 level. One of the things that we're really watching for here is because of all the stimulus and the monetary policy and things that are happening right now, a lot of people are saying this is going to just destroy the US dollar. And so I like to watch that really closely and look at different exchange rates throughout the world. And so far, the dollar's been holding up. Now, at some point in the future, the dollar may completely fall apart, but that's not necessarily happening right now. We did come down to this 90 level, but for the last 6 months or so, the dollar has been in a pretty good uptrend. This is a longer term view. This is a chart that I used for one of my videos. We were coming down and hitting this double bottom at 90. And this is about the time where this arrow is when I recorded that video, not knowing what was going to happen after this. And so far on the weekly chart, we've been holding up. I always keep an eye on lumber now, just because of housing and inflation and supply problems that you're hearing about. And lumber has really been shooting up, but we saw a little bit of a fallback on Wednesday. Oil, can you believe just a little over a year ago, oil was actually negative for a while. Now we're back up into the 85s, which I'm sure you're seeing at the gas pumps. Gold, even though it's been sideways, it's chopping all over. But the people that are kind of the doom and gloomers when it comes to the stock market, well, they're in love with gold. And anytime we see kind of a positive day, they're sure this is the breakout. This is the one. The stock market's going to go in the toilet and gold's going to go to the moon. Well, at some point, yeah, that'll probably happen. But we still are in a sideways trend overall. And I'm just looking at the ETF, the GLD ETF here. It was up almost 1.6% on Wednesday, and that probably feeds into some of the weakness that we saw in the dollar. But you can see we've jumped up here before and everybody was concerned. This is it. Here it is. It's going to happen. It's what we've been talking about for 10 years, only to have it break down and be a disappointment. Silver, it was even a little bit stronger. Yeah, it really shot up on Tuesday, and then we saw another over 3% gain on Wednesday. The CRB is continuing to go higher as we're seeing a lot of the commodities, and this is stoking a lot of the inflation fears. Looking at bonds, the US yields, they came down a little bit. Bond prices went up slightly on Wednesday. So bond prices came down, but we're still seeing a real shift overall. And the yield curve, we really only pay attention to this when it gets down to this red area, but in a good, healthy environment, you'll see the yield curve tend to climb. And then looking at world yield rates, the US is number one, UK, Japan, and then the German Bund, the 10-year, it's still trying to decide if it wants to go back in positive territory as far as the yield. It would be the first time since 2019 that happened. So we'll just have to see if this does cross above the zero line. Is that going to change any of the dynamics? Then the all world bond index overall, these are prices. So as interest rates go up, bonds go down. This is still showing weakness overall with a downtrend. As far as the economic calendar, let me make this a little bigger. On Wednesday, we saw housing starts come in stronger than expected, as well as building permits. That's why these are in green. And I think I got a little mixed up when I made this calendar. It looks like the crude oil inventories will come out on Thursday. I don't follow them all that close, but because oil is going up so much, I thought this should be something we keep an eye on. And they don't really have a number that you compare it to. The number comes out and then the market just decides if it wants to pay attention to it or not. Then on Thursday, we have initial and continuing claims for unemployment, and then we get existing home sales that will be coming out. So our conclusion is the SPX is not necessarily trending if you're more conservative with the ADX indicator, but it may be beginning to show a trend, and that trend is down. Short, intermediate term, the bias remains negative. Long term, we're still looking positive. So what can we conclude from this, or what will happen on Thursday? The crude inventories, initial jobless claims, and existing home sales will come out, and we're still kind of getting into the thick of earnings season. So thank you very much. I hope these videos are helping you, and I'll talk to you again in tomorrow's video. Now I have to figure out how to turn off the recording here, because I'm doing this a little different.